Welcome to The Debate. Today we're diving into a pretty technical but very significant move by the International Monetary Fund. It's about their reclassification of India's foreign exchange management regime.
Right, and this isn't just some academic footnote. The IMF has shifted India's classification away from a simple floating exchange rate to something they call a stabilized arrangement. And that label, that change, has real-world consequences for trade, investment, and, frankly, the credibility of the Reserve Bank of India.
That credibility is the key word here. We have to remember, this isn't a new fight. The RBI fought this exact classification very strongly between late 2022 and 2024, calling it incorrect, even unjustified. So the central question for us today is the IMF's renewed pressure, which seems to be driven by, more volatility and frequent intervention under the new governor, Sanjay Malhotra, does that actually reflect a real departure from a market-driven system? I'm going to argue that the system is still fundamentally floating, and the interventions are perfectly legal measures to manage turbulence.
And I'll be arguing that the evidence, the actual operational patterns the IMF has observed, justifies the reclassification. That the functional reality of what the RBI is doing on the ground now outweighs their stated policy.
Okay, so let me start by just laying out the RBI's position, which I believe is still the most accurate description of the regime. The core thesis is that the Indian rupee's exchange rate is for all intents and purposes market determined. Any intervention, and yes, there is intervention, is legally limited to managing excessive, damaging volatility. It's a tool to smooth out these wild price swings to ensure the market is orderly. The crucial point, though, is that it is not about defending a specific price or a predetermined band. That's the hallmark of a stabilized arrangement. And I think we have to give weight to the RBI's very firm, very public pushback on this, which confirms that the underlying structure hasn't really changed, despite what the IMF might have observed recently.
I see why you're leaning on the legal mandate. I do. But let me offer a perspective that's rooted more in the observable facts on the ground. The IMF's reclassification is, in my view, both necessary and accurate precisely because of the market results we've seen under Governor Malhotra. The IMF report specifically noted, and I'm quoting here, more volatility, frequent dollar buying and selling by RBI, and price swings near key USD INR levels. Now, a stabilized arrangement in the IMF's playbook, it just means the authorities are actively keeping the rate within some kind of unofficial band. It might be wide, it might be unannounced, but it's there. And the sheer scale and frequency of the interventions we're seeing, well, it suggests that market forces are being constantly leaned against. That points to a functional change in the regime, regardless of what the official policy document says.
Warning to investors.
Exactly. I mean, for global finance, the effect is really the only metric that matters in the end. When a currency gets tagged as a stabilized arrangement, it's a direct signal to the market that the central bank has its hands all over it. We're not debating if the RBA is allowed to do this. We're talking about the outcome. The label tells an investor that the rupee might be less flexible than a true free float, and that immediately changes their math on things like hedging costs. If the central bank is jumping in all the time, while the forward market has to price in that risk, global investors need to know the operational reality, not just the philosophical one.
I'm just not convinced. Because the semantics here have huge consequences for global credibility, especially for an economy the size of India. Calling it stabilized wrongly suggests, to many, manipulation. It suggests they're holding a soft peg when their stated goal is simply volatility reduction. And I think the IMF is blurring a really key distinction. Smoothing out a crazy, erratic spike caused by, say, a huge capital outflow, that is completely different from defending a hard line in the sand day after day. One is prudent risk management within a floating system, the other is a managed currency. Calling it stabilized misrepresents that intention, and it paints the RBI as trying to fix the rate, which they explicitly say they are not doing.
But the frequency of the action changes the nature of the action, doesn't it? If you are constantly stepping in to dampen volatility, you are, by definition, preventing genuine price discovery. If that intervention happens over and over again, the functional result is price stabilization around a certain point, even if that wasn't the stated goal. When the IMF classifies a regime, they're looking at the observed variability of the exchange rate. If that variability is artificially low compared to the underlying market pressure, they flag it. Their criteria are quantitative, they're observational. They're not based on a line buried in a legal text.
Okay, then let's talk about the practical consequences of that flag, the impact on investor perception and financial flows, which is where this label really starts to hurt.
Yes, let's.
I would argue this reclassification is creating an unnecessary market panic. The stabilized tag, especially when it's just slapped on like this, signals that the RBI is more involved in controlling the INR. The immediate result is you could see downward pressure on the rupee as global players get nervous about intervention risk. But more importantly, you risk scaring off the very capital inflows India needs, the debt and equity flows. Foreign portfolio investment, or FPI, funds operate under strict rules. A currency that's labeled as managed or stabilized might get a higher risk weighting or even be off limits entirely. And that damage comes from a technical label change that I think misrepresents the situation.
That's a fair point about the short-term reaction. But doesn't the responsibility for that fall on the RBI as much as the IMF? I mean, maybe we should consider the long-term benefit of this scrutiny. The IMF's signal is a pressure point. It's pushing for more transparency, for detailed FX intervention data, for clearer communication from the RBI about what they're doing and why.
Transparency is great, but labeling a system one way when its legal structure is another doesn't build confidence, it builds suspicion.
I disagree. If the RBI is truly operating legally, then providing that transparency should actually calm investor fears in the long run. For now, this reclassification is a necessary heads-up for investors. FPI funds, pension funds, sovereign wealth funds, they have to follow strict guidelines. If their risk models see a central bank aggressively using reserves to defend a line, even if they call it volatility management, the models change. That affects billions of dollars in potential flows. Investors just can't afford to be surprised.
But here's the contradiction I can't get past. If the IMF's own source material says that under the new governor, there has been both more intervention and more volatility, doesn't that just completely undermine the idea that the RBI is successfully stabilizing the currency? Let's pivot to that, the market consequences.
I'm glad you brought that up because that apparent contradiction, more volatility and a stabilized label, is actually the key. The volatility is high because the underlying market pressures are so strong and the RBI is fighting them tooth and nail to stop the rate from breaking certain levels. This comes back to the observation about price swings near key USD INR levels.
And what do you mean by that exactly? For our listeners, why are those key levels so important?
Good question. So in FX markets, certain numbers become psychological barriers. Think 83 or 84 rupees to the dollar. If the rupee crosses, say, 84, it could trigger a wave of automatic sell orders or just general panic, leading to a much faster slide. The IMF is observing the RBI stepping into the market with huge dollar sales or purchases right when the rate gets close to these lines. That repeated behavior suggests the central bank has an implicit red line. It's this active defense, even though it's messy and creates turbulence, that leads the IMF to say the regime is, functionally, stabilized.
But again, you're assuming they're trying to fix a boundary. I would challenge that. If the goal was a rigid band, you'd expect volatility to be crushed, to be suppressed. Instead, as we've established, the rupee has shown more volatility. To me, that's the strongest proof that market forces are still dominant. And the RBI is just trying to clean up the most extreme destabilizing movements. If they were really stabilizing in a managerial sense, you'd see a much smoother, less volatile currency, not a more volatile one. The damage to global perception from this label just seems to far outweigh any supposed benefit.
But the economic trade-off suggests there's a strategy here. When you manage a currency this actively, you create winners and losers. If the intervention lets the rupee weaken in a controlled way, maybe it slides towards 84, but they stop it from crashing to 85, then your export sectors like IT, pharma, auto parts, they all benefit. They become more competitive. But your import-heavy sectors, like oil or electronics, their costs go up. This pattern suggests the RBI is making calculated trade-offs, which is a hallmark of a managed regime. A true float would just let the market sort those trade-offs out on its own, without this clear central bank thumb on the scale near critical points.
To summarize my position, the IMF's reclassification, while it's certainly based on some real observations of intervention, it risks fundamentally misrepresenting a massive, complex, and mostly market-driven system. The evidence of dollar buying should be seen for what it is: legal and necessary volatility management. It's an essential tool for a large emerging market trying to handle global capital shocks, not proof that it's abandoned a floating regime.
And I would reiterate that the actions we've seen, the sheer frequency of intervention, the behavior around key levels, the whole operational picture, they fully justify the IMF's concern in the reclassification. The label serves a critical purpose. It gives investors clarity, and it pushes for the kind of transparency from the central bank that can only strengthen market confidence in the long run. For global finance, what a central bank does will always matter more than what it says.
So the fundamental disagreement really remains: should the label reflect the central bank's stated legal intent to smooth out rough patches, or should it reflect the observable consequences of its actions on currency stability and how global markets perceive it? Both are, I think, credible ways to look at the data.
And the latter provides a necessary alert for investors trying to navigate that complexity. It certainly opens the door for a much deeper conversation about how these classifications affect India's financial framework and its growing role in the global economy.